Minneapolis Fed, I'm supposed to mention that these are my views only. And so I'm going to talk about, in the two lectures, about risk and beliefs and the interaction of the two. And in the first lecture, I will specifically talk about one interesting set of moments that we can look at in asset prices, and that is the term structure of risk. So I would like to start with a with a one-page summary of macro asset pricing literature over the last 40 years by now. So when you go back to the 1980s, right, people like Bob Shiller and Lars Hansen with Ken Singleton and others started writing papers which exposed with certain features of models written at that time, okay, that were puzzling in the sense that they couldn't, these models could not fit the empirical evidence that we had. In particular, the very simplistic models that we wrote at that time showed or exhibited too little asset price volatility, risk premia that were too low, risk-free rates that were too high, etc. And this was coined asset pricing puzzles, although really the puzzles were puzzles from the perspective of the models. Why are the models so deficient? During the 1990s, people started inventing interesting ways how to introduce more risk and more compensation for risk into the models. And whole classes of models suddenly appeared that focused on risks that accumulated for a very long periods of time, the so-called long-run risk literature, which like current governor of the Bank of Israel is like heavily contributed to. Disaster risks, so large drops in consumption and large drops in cash flows. Habit formation, uninsurable risks and heterogeneity among consumers, etc. And suddenly we had many ways or many possible candidates for explaining these puzzles. Right? So all these models generated high risk premia, volatile returns, like all the basic, they fitted all these basic moments. And then during the 2000s, this whole literature exploded in the sense that people introduced many various ways how actually different aspects of the macroeconomy could affect asset prices, okay? And all these different aspects again spoke to similar asset pricing evidence. So people wrote papers where not consumers but financial institutions started being the marginal investors in the asset markets and drove asset prices, the so-called intermediary-based asset pricing. People wrote models with more interesting sources of market incompleteness that relied on limited commitment, private information, market segmentation, and people started introducing like, new aspects of the macroeconomy into the models, like housing or labor markets. And this actually brought some new challenges. In particular, now one of the key challenges that we are facing is how to actually distinguish between all these models. Okay? Are these models explaining, since these models try to explain the very same moments in asset price data, right? Are they actually describing the same sources of uncertainty and compensation for uncertainty, just using different functional forms? Or are they actually contradicting each other? Well, so we would like to look for evidence, okay, or for new sources of discipline of these models, or for new ways how to test these models. And some of these models actually do provide additional ways how to test them by looking at the microstructure of these models, okay, or micro foundations of these models. So in particular, models with cross-sectional heterogeneity of people's consumption, okay, will allow us to actually look at this cross-sectional heterogeneity of consumption in data, for example. Okay. There are some obstacles to this. Right? So for instance, when you look at the cross-sectional distribution of consumption or you look at the micro-consumption data, they are very noisy. So the question is how to actually discipline this data and bring this data to use to test these models. Okay. Similarly, for instance, models based on or the intermediary-based asset pricing, where where constrained financial institutions are the marginal investors, allow us to relate the tightness of these financial constraints to asset prices. But of course, the question is how to measure the tightness of these financial constraints, etc. Right? So in this talk, I will look at a set of moments that emerges from asset prices that I think is actually useful, okay, and will be telling about or will allow us to distinguish between some of these macro finance models. And the set of moments will be based on this term structure of risk. So what is the term structure of risk? So it's like for those of you who studied the term structure of interest rates, this is the risk counterpart of that. So think about financial assets, okay, meaning cash flows, with different maturities. Right? So think about, similarly when you think about bonds that mature at different dates. Right? So think about claims on dividends in different quarters. Okay. So these different financial assets earn different risk premia, and we have evidence on this. Okay. Why do they earn different risk premia? Well, because they are exposed to different they are differentially exposed to risk. Right? So dividends that, for instance, pay off soon or close to today, okay, might be more risky than dividends that pay off further in the future, okay, but when we properly annualize our measures of risk. And also the risk compensations required by investors will differ by the maturity or by the horizon of these cash flows. Okay. So we'd like to have methods, okay, that would allow us to study asset pricing models, okay, in order to understand better the term structure of the differential exposures to risk and the term structure of these risk compensations. As I mentioned, this is similar to studying the term structure of interest rates, but now things are a little bit more difficult because models that generate large risk premia and fluctuations in asset prices typically feature substantial nonlinearities, so that's something that we'll need to deal with. They feature many interesting price shocks, okay? And we specifically want to distinguish between these risk exposures and compensations for these risks. Yes?
What do you mean by term structure?
Sorry?
What do you mean by term structure?
So by term structure, I mean that you have payoffs that mature at different horizons. Right? So we have a claim that matures in 1 year. You have a claim that matures in 2 years, 3 years, etc. Right? So the term structure, okay, is the dependence of risk premia on these different cash flows on the maturity of these cash flows. Yeah. Yeah, so similarly, like the term structure of interest rates is the dependence of the yield or the interest rate on a particular bond on the maturity of the bond. Yeah. And please ask questions so that it's not only me talking here. Okay. So what I will do in this talk, I will develop a particular set of tools that will be useful for this purpose. So I will construct objects that I will call shock elasticities. Okay? And these shock elasticities will represent the following. Okay? I will ask, okay, what happens to the payoff of a particular asset with a particular horizon at which it pays off, okay, when I expose this asset marginally more to a shock next period. Okay? And I will also ask what happens to the price of this asset when it will be marginally more exposed. Right? So mathematically, this will be very similar to nonlinear impulse response functions that many of you may know from macroeconomics. Okay? Let's study the following question. Imagine I have a dynamic system in the form of a stochastic process, and I want to ask what happens if the stochastic process gets shocked today. Right? What happens if it is marginally more exposed to a shock? So what do I do is, well, I take a counterfactual exercise in which I shock the system at date 0, and then I trace out the impulse response, okay, the response of the system to this shock. Okay? So what I will be doing here is I will try to trace out the response of what happens to these cash flows at different maturities in the future when a shock affects the cash flow today. Okay? And what happens to prices of these cash flows. And that will be important because these two comparisons will tell me what is the exposure of these cash flows to risk and what is the compensation for this risk.
So when you speak about the term structure, it's fixed ones or these are each one of them is a probabilistic event? As a stochastic behavior. The terms themselves, that you get to fail.
Yeah, so
Fixed or they are probabilistic.
So the payoffs are stochastic, right? So what I will be studying is what is the sensitivity of expected payoffs, okay, to a marginal increase in exposure to risk today. Okay? So you are definitely right that because these payoffs are stochastic, right? Exposing this payoff marginally more to risk today will lead to a distributional change in the future, right? So I somehow need to summarize this distributional
Why do you call
response.
it a noise at rate zero? It's a noise at stochastic, right?
Oh yeah. So what I will so the whole cash flow will be stochastic, okay? And I will construct a counterfactual exercise in which to this whole stochastic cash flow I add a little bit more risk today, and I want to study how the stochastic cash flow changes and how the price of this cash flow changes. Yes? I'll be specific about that. So I'll postpone this question. Right? So once I introduce like the framework, it will be much clearer. Okay. Yes?
So what is observable here?
So I'll show you some data. Yes, so I will show you some data on this.
How many years of data do you need to begin to confront the models with data?
So that's a very good question. So once I get to the data section where I empirically motivate what we are doing, we will have some discussion about how reliable the data aspect of this is. And there is some controversy in terms of what the evidence actually is showing. So the empirical counterparts, okay, so of these cash flows are traded contracts, okay, that used to be traded over the counter or could be synthesized.
But they're realized by they're realized.
Yes. Yeah.
The risk you never see.
No. So this is why.
Observe it.
So this is why I need a model that tries to understand these prices. Okay, so this is the framework so this is the outline of the talk. So first I'll introduce the general framework that I will want to study. Okay, then I'll show you some empirical facts to be able to see what the evidence is actually showing, and then I construct the objects of interest, so these shock elasticities, and then I'll show you some application, how these shock elasticities can be constructed in particular models, and what do we learn from these exercises about how the model actually operates and in which ways it can speak to this empirical literature. Okay, so let's start with the framework. So I will work in what is well known as an arbitrage-free framework. So in particular, I will study a discrete time framework. So time will start at 0 and will go to infinity. There will be some cash flows that I will denote G with subscript T, denoting the time at which this cash flow is paid out. So think about G as being, for instance, aggregate consumption paid out at time T, or aggregate dividend paid out at time T. Okay. And then in order to be able to price things, I need to construct a stochastic discount factor. So I'll think about a stochastic discount factor, which I will denote as T. Okay. What is a stochastic discount factor? A stochastic discount factor is a process whose increment, okay, represents the marginal rate of substitution, okay, that a marginal investor assigns to exchanging 1 unit of consumption tomorrow to 1 unit of consumption today. Okay. And it's called a discount factor because people's preferences are typically such that people discount future cash flows, right? So cash flows paid out in the future are typically less valuable than cash flows are paid out today. And it's called stochastic, okay, because the marginal rate of substitution depends on the realization of the state tomorrow. Right? So in particular, when we are in a good state tomorrow, okay, the marginal utility of consumption tomorrow is low. So the realization of the stochastic discount factor will be low. Okay? Whereas when we are in a bad state tomorrow, the realization of the stochastic discount factor will be high. Right? In this sense, the marginal rate of substitution. A typical example, think about an investor that maximizes separable utility of this type. Then the marginal rate of substitution is the usual form with the time preference and the ratio of marginal utilities of consumption. Now, of course, okay, this stochastic discount factor may not be consumption-based. For instance, in the intermediary-based asset pricing, this stochastic discount factor will be derived from financial constraints of financial institutions. But we know that in a no arbitrage framework, such a stochastic discount factor will always exist. So when you think about investors in this market, we know that investors' optimization, okay, will lead, okay, to the following valuation formulas. Okay. So think about an asset, okay, that is a claim on this cash flow GT that pays out in every period. So we are now pricing the total stream of dividends from tomorrow till infinity. So we know that given investors' optimization, asset prices need to satisfy the following Euler equation that expresses the fact that the purchase price of the asset today must be the expected discounted resale price plus the dividend tomorrow. And this recursive formula can be iterated forward, okay? And under a condition that precludes the existence of any rational bubbles, we get that the time zero price of this asset is just the sum of the present discounted value of all these future dividends. Now, when you think about this as being the aggregate dividend on the S&P 500, this should be the value of the S&P 500. Right. Now, what I want to think about, and now we are coming to the term structure of these individual cash flows. What I will now be thinking about is the following. Let me actually split the claim on the total dividend, okay, into the sum of the individual claims on dividends that pay out that are paid out in individual dates. All right. So GT is the dividend paid out at time t, and I want to price just this cash flow. Oh, sorry. Okay. Well, this cash flow, this GT paid out at a single date, is called a t-period dividend strip. And its price is nothing else than just the discounted expected dividend. And so what I want to study is now the riskiness of these dividends, GT, as a function of t, from the perspective of time zero, and the valuation of these dividends from the perspective of time zero. And this is the value of these dividends. Yes? Okay, so t in the brackets just means the horizon. Okay, this is just this t. So this is the price of a claim that matures t periods ahead. Okay. So now imagine that I purchase this claim at time zero, okay, and I hold it till maturity. I hold the claim till period t. Okay. What is the total return? Okay, from holding this t-period dividend strip from 0 till maturity, R0t, well, it's just the payout, okay, that I get at maturity, okay, divided by the current price, right, divided by the time zero price. Okay. So the yield, or the expected annualized return in logarithms, is just the following formula. I just take the expectation of this at time zero, right? So this involves the expected dividend divided by the price. Okay. I take the logs and I annualize. And this is the formula. Now, what I would like to do now, before I actually get to measurement, okay, I would like to look not at the total yield, which would also include the return accrued from holding the risk-free asset plus the risk premium. Right? I would like to subtract the yield on the risk-free asset. And what is the yield on the risk-free asset? Well, it's nothing else than the same calculation of the return, just replacing here the GT with a 1. So 1 is the payout of a safe bond maturing at time t. Okay. So when I repeat this exercise, right, for this safe bond, I will get a 0 here, and I will get only the log of the expectation of the stochastic discount factor S here. G is 1. Right? So when I subtract it from this original formula, I just subtract this minus log the expectation of the stochastic discount factor. So minus and minus is a plus. So the formula for the risk premium, that is the expected return, okay, on this t period cash flow, GT, which is risky, in excess of the yield that I get on the safe bond is this. Okay. And the term structure of risk, okay, now involves studying RPT as a function of t. Right? So these risk premia differ with maturity. Okay. And again, they will encode both the riskiness of the cash flows, how risky these cash flows are, these GT, as well as the compensations for the risk, which are embedded in the marginal rate of substitution in the stochastic discount factor. Right? So in particular, when the cash flow will be very risky, right, then GT will be very volatile. When the compensations for risk are very high, that's a situation where the stochastic discount factor is very volatile. Okay, so now okay, I want to look at these objects in the data in order to just collect the empirical evidence. Okay. So let's look what the empirical literature is actually telling us. Okay. So we would like to measure these risk premia, okay, on these dividend strips with different maturities. Now, the problem is, what can we actually observe in the data? Okay. So when you look at these objects, okay, and let me start with the second one. Okay. This object is the price of a claim on a dividend that pays out at time t from the perspective of period 0. So if these claims are traded, I will see this price. I have it. Right? This is the negative of the price of a t-period bond. Right? So if the bond is traded, I see it. Right? So this taken together is actually a forward contract, okay, where I take the price paid out in the future and I net out the yield on the risk-free bond. And that's something that gets traded in financial markets. Right? So at time 0, I can observe the price of this contract. Okay? Now, there is some issues with where is it traded? So we know, so we have some data on exchange-traded futures contracts of this type post 2004. Okay? And this goes back to your question regarding what time span we have. And Jules van Binsbergen and Ralph Cohen and their co-authors, they have some OTC price data on the earlier period as well. Regardless, the time period for which we do have the data is relatively short. So bear that in mind. The bigger problem is with this object, because that's the expected dividend, right, which I do not observe at time 0, because there is no contract on expected dividend. Right? So if it was traded, like a dividend contract, it would be risk adjusted, and then I would not observe this dividend expectation. So what can we do? Well, if you want to measure this risk premium, we need to construct this object somehow. So you can either set up a forecasting model that forecasts future dividends, or you can rely, with limited success because of limited data availability, okay, at some survey forecast. Okay. Regardless, Jules, Ralph, and co-authors actually attempt to construct several measures of these expected dividends in order to arrive at this risk premium. So what is the evidence that they actually collect? So in their first paper, that's the AER from 2012, okay, they show, okay, that when you look at the average returns on a one year ahead dividend contract, so that's the return on a contract on a dividend that matures in 1 year, and a 2-year dividend contract, and you compare the average returns, okay, with the average return on the S&P 500 on the total stock market, these average returns are much higher. And so are Sharpe ratios, as ratios of average returns to volatilities, okay, when you compare it to the stock market. And it holds both for the earlier period for which they have OTC data, as well as for a later period for which there are futures contracts. So they interpret it as a sign that the term structure of this risk premia is downward sloping. Why? Because when you think about the return on the total S&P 500, it consists of aggregation of returns that properly weighted on the individual dividend contracts, right? From maturity 1 to maturity infinity. Because the returns on the dividend contracts that mature early, within 1 or 2 years, are much higher than the return on the total market, it must be that at longer maturities, these returns must go down, so that they average out, once we account for all of them, to the return on the total market. Okay. Yes?
To me, this depends on how we perceive the economy at present. So now we are in a good time or a bad time.
Perfect. The second piece of evidence, okay, comes from time variation in this risk premia that they construct. Okay. And what they show is that the slope is actually changing over the business cycle, meaning that it's much steeper, much more downward sloping in recessions. Okay. This kind of sounds intuitive, right, because it says that risk premia associated with dividends that mature very soon to today, okay, are much higher than risk premia on the long-term dividends, okay, when we are in a recession. Right? Well, it makes sense. We are now in very risky times, right? These dividends are very risky. People are also very risk averse, so they require high compensation for risk. So therefore, risk premia on these short-lived assets must be high relative to the risk premia on assets, okay, which pay out in times which presumably will be already recovery time. Right? So this is exactly the point that they make, that there is a very strong countercyclical feature of the slope. Okay, the slope is high, okay, meaning high negative, okay, in recession.
Always negative.
That's what they claim. But,
How persistent are
sorry?
they? How persistent are they?
So this is their proxy for the risk premia, okay, starting 2003 to 2011. Okay. You look at the time series. They may, I just don't remember the numbers. Yeah. I don't care so much about the autocorrelation of the risk premia per se, because they will heavily depend on the properties of the underlying macroeconomy. Right? So,
Right. The point is, go back to the previous slide. You have 80% after that persistence, and you have far fewer than 80%.
oh yeah, okay.
Ahead of the base.
Oh yeah, so from this perspective, so think about this autocorrelation as being business cycle autocorrelation, right? So that's one thing that I completely agree with, okay? If you look at the data for which they actually have, or when you look at the time period for which they have liquid data, okay, it essentially involves 1.5 recessions, which is very little. Completely agree, yeah? So I'm completely with you that the information, okay, if we think about this risk premia as ultimately being drawn from some stationary process, the time series is short. I'm with you. Oh, sorry. Yeah, thank you.
If I have a contract in term, you likelihood of payment is low. So why is this not part of the risk? Why I don't understand this.
So you think about counterparty risk, where
Exactly.
so post 2004, these are exchange traded. So in terms of the counterparty risk in an exchange, I think it's very limited. Okay, pre 2004, those are contracts traded with like the big banks like Goldman. Okay. So I don't know. So perhaps Daryl might have better empirical evidence on what the counterparty risk like in terms of trading these forward contracts with Goldman. I don't know. It might be a good question. It's very low. Okay. Good. Yeah. Thank you. Yeah. So Van Binsbergen and Cohen updated their pictures recently to also include Europe, Japan, and the UK. And in all these countries, when you actually look, so what they plot here is not the risk premia. What they plot here are the cumulative returns on these individual contracts. Okay? And when you look at the cumulative returns on these individual contracts with maturities 1 year, 2 years, 5 years, and 7 years, 1 year, 2 years, 5 years, and 7 years, and you compare it to the cumulative return on the stock market, they are all higher and they are downward sloping. They're all higher than the dotted line and downward sloping. Again, less of a downward slope here, but all higher than the return on the market, meaning that the longer-term dividends must earn lower returns so that it actually averages out to the stock market. The only country where the evidence does not line up with the three remaining ones is the US, where they actually show that the cumulative return on these individual contracts or on these dividend payouts with different maturities, the cumulative returns are actually increasing with maturity, but they're all higher than the return on the stock market. Meaning that if the stock market is the average of all these, there must be some longer-term dividends whose returns must be lower, or at least implicitly, even though they are not traded. So again, at some point, the term structure should start sloping down.
And what is that?
They don't report it. They don't have data on that. So that's only implied by no arbitrage. Right? If the stock market is the sum of all dividends, and we assume that there is no bubble in the stock market, then it must be that there must be some returns in the future that on very long-term dividends that are lower.
So is the assumption that there's no bubble too restrictive an assumption?
So that's a good question. We have some recent papers by people like Matteo Maggiore and Johannes Strebel who study bubbles that compare very long-lived contracts on housing and so on with which have finite maturity, for which bubbles cannot exist by definition, with perpetuities, and they show no meaningful price difference, which implies that there is no bubble. Okay. But the evidence for the stock market is less clear. Okay, but yes. Yeah.
I now understand what I don't understand because of the previous question. So what is the risk on? So what, in terms of a lottery, what should happen? The firm decides not to pay the dividend, or the firm goes bust? What happens?
Yeah, so these are claims on aggregate dividend paid out in a particular quarter, okay, of all S&P 500 firms. Okay, so that there is risk in terms of how much the dividend will be, the total dividend. Thank you. Yes. Yeah.
I'm just wondering, these contracts are all very similar in terms of other features. I'm thinking, for example, liquidity. Are they like very similar to each other? Because otherwise, it could be that, for example, 1-year contracts are not really traded that much because.
So in terms of like the differential liquidity of these contracts, it's similar, but it's lower than something like the S&P 500 index. So that's for sure.
So
Yeah.
that might be, for example, an explanation that there is a liquidity premium as well.
Exactly. So there's actually some controversy regarding these results, and There have been papers written arguing that the preceding authors ignore some details, like that turn out to be important, like differential tax treatment of these different contracts, okay, and in particular trading costs. So when you have contracts that have lower liquidity, then bid-ask spread, so prices at which you can sell and prices at which you can buy, can differ a lot. So once you actually construct a trading strategy, okay, that depends on sequential selling and buying of these contracts, you might end up incurring high trading costs. Once you actually account for that, Bansal, Yaron, and their co-authors in their recent paper, which is still like work in progress, argue that the term structure is actually increasing. Okay? So that the risk premia are actually lower, or at the short end of the dividend yield curve. Now, having said that, despite the fact that there is disagreement that people in the empirical literature need to work out, it's still useful to actually have methods in order to be able to understand how our models perform. Because even with the limited data and perhaps noisy data we have, we would like to take the models and fit them to these data, accounting for all these possible mispricings and errors. So this is what I will be talking about. Okay. So let me now construct the objects of interest here. So these shock elasticities. What will I? So in order to do that, I need to first introduce a formal environment, right? So that I can specify what I mean by risk and compensation for risk. Okay? So the stochastic environment will be very general and will actually encompass a very large class of models that people in macrofinance are using. So we will assume that there is a Markov state, xt, which is a vector, the state variable, okay, that follows some Markov process. Okay. I will leave it unspecified at this point. Okay. The conditions on this xt are very mild. Right? So typically this xt will emerge as a state in a macro asset pricing model that you solve, and will involve some exogenous drivers like technology and various other shocks, as well as endogenous state variables, perhaps capital, etc. And this Markov state will be affected by a vector of Gaussian innovation. So those are the shocks that hit the macroeconomy, okay, and that cannot be diversified. Okay. So think about technology shocks, shocks to financial markets, external conditions, etc. Okay. And they will, of course, depend on the particular model that we specify.
One, right?
Oh, yeah, so that's I, that's the unitary matrix. Yeah, because this is a vector. Okay, so this is a vector of shocks. Okay, so this is the unitary matrix with ones on the diagonal. Okay. So the cash flows and stochastic discount factors, the two key objects that I will want to model, okay, will be modeled in the following way. I will assume that the increments of these cash flows and stochastic discount factors, here I'm using M as a generic letter for either the G or the S, okay, are stationary functions of the Markov state. Okay. So they are functions of the Markov state and the possible innovations that hit the economy in the next period. Why do I specify it in this way rather than, for instance, specifying the level of M as a function of xt? Why do I like growth rates as a function of xt? Because a lot of the leading asset pricing models, okay, generates dynamics that are stationary in growth rates and that allow for stochastic dynamics that involve stochastic growth, okay, rather than growth along a deterministic balanced growth path with some wiggles around it, okay, and stochastic decay, so that I can model stochastic discount factors in an interesting way. Okay. And actually all models that meaningfully capture features of asset prices that we see in the data, like high risk premia or volatile returns, will involve stationary growth rates rather than stationary levels. Okay. So that is important for quantitative applications. Okay. So in order to give you an idea how these shock elasticities work, let me actually abandon for 5 minutes okay, the logic of the term structure, and let's think about just one period pricing. Okay. So let me assume a very simple model for cash flows and the stochastic discount factors. Let me assume that the cash flow in logarithms is just given by some beta that can be a function of the state today at time 0. Okay. And notice the cash flow is the cash flow that matures at period 1. Okay. So this is nothing else than but the conditional growth rate of the cash flow. Right? And some conditional exposure of this cash flow, alpha g, to these innovations. Right? So cash flows will be riskier if these elements, so alpha g is again a vector, right? And this is a dot product with the vector of shocks. So the g will be riskier if these elements of this alpha g are larger, right? So the cash flow will be more exposed to the fundamental shocks. Okay. And similarly, I can think about modeling a stochastic discount factor in the same way. Again, it will have some conditional growth rate, and it will have some conditional exposure to these shocks. We have, I think, okay. So if I write here, can you all see it? Okay. So think about, okay. So think about like the standard, think about an example of a CRRA utility, right? Where S1, the stochastic discount factor in period 1, would be just beta C1 over C0 to the power of minus gamma, right? Where C is aggregate consumption. And I can model aggregate consumption in the same way as the aggregate cash flow with just different coefficients. So log C1 minus log C0 will be just beta C, so that's some parameter vector beta C of x0 plus alpha C of x0, okay, times W1, right? Where beta C and alpha C can be inferred from the properties of aggregate consumption that we see in the data, right? And exposure of aggregate consumption to these fundamental shocks, okay? Then this log S1, this increment of the stochastic discount factor in logs will be just minus gamma, right? It comes from the exponent times the increment of consumption, right? So again, beta S and alpha S will be just minus gamma times these parameters. So that would be an example from the consumption-based literature. Now in this environment, I can construct a one-period return. That's just the payoff, G1, divided by the price of this cash flow in period 0. So that's the payoff. And the price is just the expected discounted payoff tomorrow, conditional on the state today. Right? So what is the risk premium? Remember, I have the formula for the risk premium, so I can just repeat it here. Okay. Now I do not normalize by horizon because the horizon is 1, so that 1 over t, that was 2 slides back, is just 1. So it's just the expected payoff net of the price, okay, net of the yield on the risk-free bond. Okay. And when you actually compute that, it's a simple, so in this environment, because these shocks are normal, okay, S and G in levels are log normal, so you can just apply the log normal calculus, and you can compute the risk premium as the dot product between alpha G, that's the vector of exposures of this cash flow to risk, and minus alpha S, that's the vector of prices of risk. That's how exposed the marginal utility of the investor is. Right? And the dot product is the risk premium. So the risk premium, right, is the sum of products of exposures of the cash flow that we are pricing to risk times the price that the investor assigns to exposure of this cash flow, right? And then you sum across all these. Then you sum across all these shocks in the dot product. Okay? So now this gets us to the idea, to the conceptual idea that risk premia, okay, involve both risk exposures as well as compensations of required by investors. Right? And again, this minus alpha S, when you think about what this is from the perspective of a CRRA utility consumer, right? So minus alpha S will be just minus gamma times alpha C. So it will be just the gamma times the exposure of aggregate consumption to this risk. Right? So this is a very simple asset pricing model. Right? And actually, this is like the one-period version of models that people in the 1980s wrote down. Right? CRRA utility, stochastic discount factor based on aggregate consumption, okay? And then some choice of risk aversion, okay? With some moderate values, like 2 or 3. And what this literature concluded, that when you actually try to price cash flows and compute this object, right, in order to get the risk premium, okay, this number will be way too small compared to the risk premium we see in the data. So that was the risk premium puzzle. So this is nice. Now we can compute the risk premium in this nice way. The problem with this computation is the following. In the moment when you move to longer horizons, and when we move to more nonlinear models than just this simple example, like the type of models that we actually write down in asset pricing, this simple formula becomes incredibly complicated. Because when you think about long horizons, right, then the risk premium on a cash flow that matures sometimes far in the future is affected by all the shocks that hit the cash flow between today and the maturity of the cash flow. The shocks can interact in nonlinear ways, right? And this nice decomposition fails. So what I would like to get at is a method that would recover, okay, the notion of a marginal compensation, the notion of a marginal exposure to risk of a cash flow that matures far in the future and that is affected by these nonlinearities, and the notion of the marginal compensation for this risk. Okay? So in order to give you the idea how this works, let me start with this one period example, and then I extend it to multiple periods. So instead of doing the computation directly, let me propose the following. Okay? Let me propose a family of so-called perturbations. So what is this perturbation? Okay. This perturbation is a random variable that is realized in period 1, and it is parameterized by this perturbation parameter R. Okay. Forget for a moment about this. Let's focus on this. Okay. So what is this perturbation? This perturbation, okay, is nothing else than a random variable that is exposed to these fundamental shocks that are collected in this W, so technology shocks, financial shocks, etc., where alpha H is the direction of the exposure. And I, as a modeler, can choose this alpha H. So if I'm interested in the sensitivity of these cash flows to, say, a technology shock, I will choose an alpha H, okay, that has a single 1 in the place that corresponds to the position of the technology shock in this vector W1, and I zero out everything else. But I can do anything I want, so this is my choice. Okay. And this R is a perturbation parameter, so I'll think about small perturbations, meaning I will try to drive this R to 0. Okay. This term here is just a correction that makes sure that the expectation forget about this. This term is just a correction term that makes sure that the expectation of H is 1. Right? So for those of you who know log normal calculus, this is just the minus 1/2 sigma square. Right? The reason why I want this correction is that I want a perturbation that is on average neutral, okay? That does not shift the payoff in any particular direction. Okay? And what I will now construct is a perturbation of the original payoff G1. So G1 is my original payoff. I now want to study a new payoff that is G1 times H1. Okay? What is this new payoff when I write it in logs? Well, forget again for a moment about the drift term. Let's focus on the exposure term, the exposure to these fundamental shocks. Okay? So this new cash flow, G1 times H1, okay, is a cash flow whose exposure to risk now is alpha g plus r times alpha h. So what did I do as a modeler? Okay, I perturb the cash flow by assigning more risk exposure to this cash flow in a direction I like, alpha h. Okay, and because r is small, this perturbation is small. Okay. And of course, when I choose r0, this is the limit where I'm back to g1. Yes? No, so that's a deterministic function potentially of x0. But typically in the applications I will show you, this will be just a constant vector, okay, where there will be a 1 in one location. One element will be 1, and the rest will be zeros. Yeah. So the distribution form will typically depend. Okay, so this is my modeling choice. So sometimes I will want to choose this alpha h conveniently. And so sometimes the distributional form of this, okay, sometimes it will be useful to choose the distribution of this to line up with the distribution of this. So to line up the functional forms so that I actually can derive formulas in closed form. So, oh, okay. So careful here. So this alpha h, even though it will be potentially a function of x0, it will be known at x0, right? Whereas this is a shock that will be realized in period 1. So there is different timing. Okay. So what I now want to do is, I want to construct expected returns on these perturbed cash flows. Okay. So I repeat the exercise from before. I construct the return. Okay. I take on G1 H1. I take the expectation in logs. So this is the log expected return on the cash flow G1 H1. So this is just the formula I had before, where I replace G1 with G1 H1. So that the expected payoff net of the price. Okay. And now, because I'm interested in small perturbations, I'm going to compute the derivative with respect to R of this expected return. So I'm computing the sensitivity of expected returns, okay, to a marginal increase in exposure of G1, okay, to risk in the direction that's embedded in this H1 that I've chosen. Okay. So this formula looks ugly, and it turns out it actually simplifies quite a lot. And in particular, I will be interested in 3 different objects from this calculation. Okay. The first object that I will call the shock exposure elasticity, okay, will be the sensitivity of the expected payoff part of this formula. So just this part. Okay. So the shock exposure elasticity will be measuring how sensitive expected cash flows are, okay, okay, to a perturbation or to a change in exposure of these cash flows to risk, okay, in the direction that I choose in this H1. Okay. And it turns out that when you do this calculation, okay, what you get is the exposure vector of the original cash flow, alpha g, times the vector or times the direction of the perturbation. So remember, alpha h is my choice. I can choose it as I want. Okay. So if I choose, for instance, alpha h to be 1 only in the location that corresponds to the to the technology shock, okay, so it will be a vector of zeros with a single 1, I will recover the exposure of the original cash flow to the technology shock. Okay. Then I can do the same calculation for the second object of interest, and I repeat it, and I compute the derivative for the second object. And I will call it the shock value elasticity. Let me skip that one. The second interesting one will be what we call the shock price elasticity, okay? And that is the sensitivity of that is the sensitivity of the whole expected return to an increase in risk. Okay? And when you actually do the computation in this setup, okay, you recover the vector of prices of risk. So how costly these risks are from the perspective of the investor, okay, again times the exposure vector. So what did we obtain from this? So again, this calculation looks ugly. And we actually obtained what we had before. Right? The shock exposure elasticity recovers the vector of risk exposures, how risky these cash flows are. The shock price elasticity recovers the vector of prices of risk. Okay? What is the compensation required by investors in terms of average returns for holding this risk? Yeah. Now, the product of the two is the risk premium. The dot product of the two is the risk premium. Right? But now I was able to actually derive these two objects separately. Right? Now, I could have just looked at the original formula. Right? Where was it? Okay, here. And I say, OK, I know this is the vector of prices of risk. I know this is the vector of price exposure, of risk exposures. Okay? I don't need to calculate them separately. I know these are the two. But in a complex model, this will not be clear at all. Right? Just by glaring at the functional form for the risk premium, you will not be able to infer what is the risk compensation part and what is the risk exposure part. Okay? These calculations give you the two separately. And what is the big advantage? They can be extended very easily to longer horizons. Okay? So how do we do it with longer horizons? Well, now instead of thinking about a payoff that matures at time 1, G1, think about a payoff that matures at time t, GT. Take this payoff. This payoff is hit, lives from period 0 to period t, and then it pays out, say, the aggregate dividend at time t. Okay? The terminal payout is affected by all the shocks that hit the macroeconomy along the way. Right? And potentially generates nonlinear dynamics and so on. Okay. What I want to do is, I will now take the payoff. This is the stochastic process that matures at time t. And I will perturb it again in period 1. Right? So I'm in period 0, and I construct a next period perturbation. I make the cash flow process marginally more risky next period. And I trace out the consequences of this increase in risk next period, okay, at some future date t, when the payoff is paid out. Okay. And again, I take this perturbed payoff and I construct the expected return on this perturbed payoff. And I can derive the shock exposure and shock price elasticities exactly in the same way as before. All right? So the shock exposure elasticity will study the marginal change in the expected payoff as we perturb it in period 1. And the shock price elasticity will measure the marginal change in expected return, okay, on this payoff whose risk we perturb in the next period, or whose riskiness we perturb in the next period. Okay, so it turns out that actually these shock exposure elasticities and shock price elasticities, even for longer horizons, have very convenient functional forms. So in particular, think about the shock exposure elasticity as an example, this epsilon g. So that studies the sensitivity of expected payoffs to marginal increases in risk. Okay. It's nothing else than the covariance, okay, of the expected payoff with the shock W1. Okay. Sorry, not expected payoff. It's the covariance of the payoff with the shock W1, okay, normalized by the average level of the payoff, okay, interacted with the direction in which I'm studying the change in exposure. Right? So this covariance, that's a vector because W1 is a vector, and this is just the dot product with the direction that I'm interested in studying. I can do it also for the shock value elasticity and shock price elasticity. The important point is that all I should be interested in is studying these covariances. Right? And in many models, they can be computed very efficiently. So to summarize, why is this calculation actually useful? Okay. Because when we think, and I will just recap what I already said, because when we think about the risk premium, okay, now this should be RPT, that's a typo. Okay. So that's a risk premium, okay, as the cumulative return that we earn on holding this asset That is a claim on this dividend till maturity, net of the yield on the risk-free bond. Okay? So this risk premium depends on all these shocks W1 till WT, right? These shock vectors that hit the model, right? And these shocks interact nonlinearly. This calculation isolates the contribution of a single shock in the sequence of shocks. Right? We can think about this as the fundamental building block of the risk premium, because now you can start accumulating the contributions of all these different shocks in the future, and you would arrive at the total risk premium. Okay? But this isolates the effect of a single shock. Now, for macroeconomists, this is something that should be very familiar. Okay? Because this calculation, the shock elasticity calculation, is the analog of an impulse response function. What do I mean by that? Think about a simple linear model, okay? A simple vector autoregression, where x, t plus 1, is just a linear function of xt, where the A is some matrix, okay? And some fundamental shocks with the matrix of exposures B. Okay? So this is a standard vector autoregression. And now assume that my M, okay, and again this is my cash flow or my stochastic discount factor, okay, is a linear function of the state and the shocks. Right? So that's a standard linear environment. So when I want to construct an impulse response function, what do? I take my shock in period 1, W1, and I perturb it by a constant. Right? I start from steady state, I perturb the system by a constant, and then I trace out the response. Okay? And that is I trace out the response of M. And that is the impulse response of M to a shock A in period 1. Right? Now here, it is particularly simple, okay, because of the linearity. The linearity of the system implies that the shocks that hit the system in different periods do not interact. They are additive. Right? So the fact that I perturb the system today, okay, does not affect how the future shocks affect the system. Right? Because of the additivity. Whereas my calculation in the nonlinear world needs to take into account that when I increase the risk today, okay, this increase of the risk will put the cash flow on a different path in this nonlinear system, and the cash flow will interact with the future shocks differently. Right? So that's something I need to account for. Okay. And this is what the shock elasticities actually do. In the linear system, in the log linear framework, if my cash flows and my stochastic discount factor were log linear of this form, where it would satisfy, then I would actually not need the whole shock elasticity framework. I would actually get the same answer in terms of risk exposures and risk compensations if I just studied the impulse response function in this system, okay, for log of the cash flow and for the negative of the log of the stochastic discount factor. I would get the same answers. Okay. So what I did here is I introduced a very simple setup, but the methodology actually extends to a variety of frameworks. So in particular, we have a paper where we treat this setup in a continuous time, where we have regime shifts and Brownian shocks. Okay. In another paper, we make a more formal connection to nonlinear impulse responses. And finally, we have a paper where we also have an implementation in the form of a toolbox in Dynair, which is on my webpage. So if you ever want to play with this, you can just download the toolbox and integrate it to Dynair, and you get all these analyses for free. There's also recent work by some other people. So in particular, Irina Zviadadze from Stockholm has a very nice paper where she generalizes this logic to non-Gaussian shocks. And there are some additional challenges to be dealt with when the shocks are not Gaussian. Okay, so let me actually get now to the method, to an application part. So what I now want to do is I want to take a quantitative asset pricing model, and I want to apply the methodology in this quantitative asset pricing model, okay, to get an understanding how this asset pricing model actually works. Okay. And so the asset pricing model will be a model that features the so-called long-run risk. And this is a framework that Ravi Bansal and Amir Yaron worked on for a long time, and now it became one of the workhorse papers in the literature. Okay. So what is the logic? And in particular, this specification is the discrete time version of the specification from our paper, but it does not differ substantially from what Bansal and Yaron have done. So what is the stochastic environment? So in this stochastic environment, my state variable will have two components. So the state vector x will have x1 and x2. And then my consumption growth, okay, log Ct plus 1 minus log Ct, will be of the following form. So there will be a constant contribution. Okay. Then there will be a conditional mean of this consumption growth. Right? So this is the consumption growth between t and t plus 1. So this is the conditional mean of the consumption growth because it's affected by x1 t. Right? So it's known at time t how much consumption will grow incrementally over time. And this x1 t follows this mean reverting process, okay, where mu1 bar is the coefficient of mean reversion. Okay. And I get to this volatility term in just a second. And then this consumption growth is also affected by innovations, okay, that have so-called stochastic volatility, meaning that the volatility of these innovations is driven by this second component, x2t. Okay. And x2t again follows a mean reverting process with mean reversion mu2 bar. Okay. And all these innovations are scaled by the same volatility. That's a convenient functional form. So what does this model, what kind of risks does this model feature? Okay. So this model features the, how does the consumption growth look like? First, there is the trend component of consumption growth. So we know that every period, on average, in unconditional mean, okay, consumption will grow by beta 0c. Okay. But then the conditional mean of the consumption growth varies over time with x1t. Right? So there are some periods where we know on average consumption growth will be high, like good times, and periods when consumption growth will be low, like bad times. Right? So this x1t plays the role of the conditional mean changes, and this term is what gave the name to the model, the long run risk model. And in addition, there is a third component of risk that comes from the fact that the conditional volatility of these shocks changes over time as well. So this is the stochastic volatility. So there are three sources of risk. Okay? So there are three shocks, and the consumption growth over time is exposed to all of them, right? It's directly exposed to the shock WC t plus 1, okay? But it's also exposed to the shock W1, right? Because if there is a positive W1, okay, that will increase x1, okay? And because this is a mean reverting process, that means that in the near future consumption growth will be higher than usual because of this x1, right? And finally, consumption growth is exposed to W2, right? That affects this stochastic volatility process, because when we have a positive innovation to W2, we increase stochastic volatility x2, and so the future increments will be more volatile. Now, so that specifies the cash flow. So in particular here, I will not be interested in the graphs I will show you in pricing some additional dividend process. I will try to price the consumption itself. So imagine that now the strips are not claims on dividends, but are claims on aggregate consumption. So I'll feature now two types of preferences that I will want to think about. The first one is the standard CRRA preference setup, where investors' preferences are given by the standard recursion with CRRA preferences with risk aversion gamma, and that leads to the stochastic discount factor that I already introduced. The second preference specification is the recursive preference specification that is due to, in this homogeneous form, is due to Epstein-Zinn, and the continuous time version is due to Darrell Duffy and Larry Epstein 3 years later. Okay? That is a generalization of the CRRA preference, okay? And which actually Bansal and Yaron used. So I have a little bit of time to talk about this preference specification. So just to explain it. So this preference specification, this recursive preference specification, became prevalent in many asset pricing models for its ability to separate the notion of risk aversion and intertemporal elasticity of substitution. The reason is the following. So when you think about the CRRA preferences, and you think about the curvature of the preferences, the CRRA preference structure does not distinguish between risk aversion with respect to different realizations of consumption in different states of the world at the same time, say tomorrow, which is like the risk aversion with respect to like risk that can hit you over time, that can hit you tomorrow, and risk aversion with respect to changes in consumption between today and tomorrow, which is the intertemporal elasticity of substitution. I deliberately mentioned risk aversion because Eric in his previous talk used the word risk aversion to what macroeconomists would call intertemporal elasticity of substitution. Okay? Now the CRRA preference structure does not allow us to distinguish between the two. Okay? And it is a problem when we want to fit many of these salient asset pricing facts. So this is why this preference structure became so widely used. And the reason is that when you think about these two parameters, what they do, think about gamma, what gamma does. Gamma risk adjusts the distribution of continuation values tomorrow. Right? So gamma is the risk aversion parameter with respect to intratemporal risks. Right? So that is the risk aversion with respect to good states and bad states tomorrow. When you think about the intertemporal elasticity of substitution, okay, so that's the willingness to substitute consumption between today and tomorrow, that's driven by this parameter rho, or the reciprocal of it. So the reciprocal is the intertemporal elasticity of substitution. And so rho drives the curvature of the CS aggregate between consumption today and the expected continuation value tomorrow that embeds all the consumption from tomorrow onward. Right? So that's the logic. Now the stochastic discount factor that emerges from this preference recursion is the following. And I simplified it by imposing unitary intertemporal elasticity of substitution, which is a very convenient functional form to work with. So what do we get? What is the stochastic discount factor? So when you forget about this, okay, then the stochastic discount factor is the same as the CRRA stochastic discount factor when risk aversion is equal to 1. That's the log case. Right? But now we have this additional term. Now, what does this additional term do? Well, this additional term increases the volatility of this stochastic discount factor. Why is this useful? Well, remember that I said that the risk premium, or we showed that the risk premium in the one period setup was minus alpha S times alpha G. That was the exposure, okay, of the cash flow that I'm interested in to risk, and that's the exposure of the stochastic discount factor to risk, right? Or in a one shock setup, this would be the volatility of the stochastic discount factor. In order to make the risk premium large, right, this is given by data, so I need a model of preferences that delivers a large alpha S, a large volatility of the stochastic discount factor, so that I can get a large covariance. Okay? Well, if I rely on a standard representative agent CRRA specification, okay, then aggregate consumption has very low volatility, something like 1% or 1.5% annually. Right. So in order to get meaningful numbers for this covariance, I would need to ramp up this gamma to incredibly high numbers, like 100, 150, and so on. And people are very unhappy about that. Okay. Now, yes? Thank you for a question. Nobody asked a question for a long time. Okay? Okay. So I hoped for a question. Okay. So here, what do we get here? Well, we get this additional term, okay, that's connected to the risk-adjusted continuation value here. Right? So this continuation value is the present discounted value of all future consumption. right? It's given by this recursion. Okay, so the consumption shows up here. Right? So how do I make it very volatile? Right? Because I want to make the stochastic discount factor very volatile. Well, I need a shock, okay, that moves consumption in a way, okay, that moves the continuation value by a lot. But I know that I can't, when the shock hits tomorrow, I can't move the consumption a lot tomorrow because I know consumption is not very volatile. I need to discipline consumption by data. But I can invent a shock that not only moves the consumption tomorrow, but also the day after tomorrow and the day after tomorrow. And all these effects of the increase in the consumption level accumulate to a massive increase in the continuation value. How do I arrange it? Well, I invent a long-run risk shock. I invent a shock that is incredibly persistent, where this number is close to 1, that affects the growth rate of consumption. So that when the shock hits the conditional growth, it stays elevated by a little bit, but for a very long period of time. So that consumption will grow by a little bit more, but for a very long period of time. And when you take the present discounted value effect of all this, okay, this massively increases the continuation value. And this effect, the marriage between these long-run risk shocks and the Epstein-Zinn preferences gives rise to this long-run risk model. So that makes the stochastic discount factor very volatile and generates the empirical success. So that's a side note. Okay? So now, what do I have? I have the specification of the cash flow that I want to price, and I want to study the risk exposures using the shock elasticities. And I have two stochastic discount factors that I can use for pricing. So let me look first at the shock exposure elasticities for the consumption process. So when I compute the shock exposure elasticity for the shock that directly hits consumption, this one, okay, then the shock exposure elasticity is completely flat. And the reason is simple. A shock tomorrow, right, lifts the path of consumption growth, okay, to a new level and stays at the new elevated level forever. Right? It's a unit root shock. Right? This is why the exposure of the cash flows with different maturities, all the consumption strips with different maturities, with respect to this direct shock is the same. Yeah, this is why the line is flat. Now I want to look at the shock exposure elasticities with respect to this shock, to the long-run risk shock. Okay? Well, these shock exposure elasticities start small, and they keep building up. Why is that? Well, when I look at the specification, when I hit the model by this shock tomorrow, this increases the next period consumption growth, right? And it also increases the consumption growth 2 periods ahead, etc. And these things accumulate, right? So consumption 1 period ahead will be affected by very little, but by 2 periods ahead it accumulates, etc. So this builds up, right, until it levels off at a constant level. Yes.
It can't consume at the expense of tomorrow, right?
So this is an endowment economy.
Yeah.
So prices of assets have to adjust so that you don't want to. Yeah. In equilibrium. Yes.
The consumption next period is actually doesn't change at all because
So
the growth in the next period changes, so only 2 periods ahead of something, right?
oh yeah, okay. So in this yeah, so okay, so can you repeat the question? Just so that I'm sure what you are.
If you change the growth of consumption tomorrow, the consumption tomorrow does not change at all because the growth takes an effect on the period after that.
Okay. Yes. So what you say is exactly right. So here I shock the growth. I shock the growth rate of consumption x1 t plus 1. So in period 1, right here. So I will do it in period 1. So the period 0 consumption growth stays the same. Period 1 consumption growth is affected. So into period 2, going into period 2. Yes. Okay. And finally, the shock exposure elasticity with respect to volatility, okay, again starts at 0. This is a 0, and then it builds up. This one is negative because an increase in volatility is actually bad for the expected cash flow. Okay. So this is why the shock exposure elasticity is actually negative. Okay? But importantly, it builds up.
Why is that for the expression cash flow? Why is it bad for the expression cash flow?
No. So when I perturb the cash flow, okay, the conditional growth of the cash flow actually decreases on average. So for the cash flow here, it's mechanical. Yeah. Okay. So what about the shock price elasticities? Okay. Well, again, the shock price elasticities for cash flows, so those are the compensations required by investors for holding cash flows at different maturities exposed to this risk. So the shock price elasticities for the direct consumption exposure are again flat. And again, the reason is that this is an IID shock that hit the consumption, okay, that increases the path of consumption, and in the same way increases the path of the stochastic discount factor. So all these compensations are constant. Okay. Now what we get, but where we get very different answers are in terms of the shock exposure elasticities for the two models between the growth rate for the growth rate shock and for the volatility shock. So in particular, when you look at the shock price elasticity for the CRRA model, which is the dash dotted line, okay? So there's the CRRA utility model. You see that these exactly mimic, okay, the shape of the shock exposure elasticities. And the reason is very simple here, because the stochastic discount factor is just minus gamma times consumption growth. Right? So because these are the shock exposure elasticity to consumption growth, these red lines are just gamma scaled versions of the shock exposure elasticities. However, a different picture emerges for the long run risk model, where these shock price elasticities are essentially flat. And the reason, and this is actually important, because what it means is that the preferences are such that despite the fact that I study the risk compensation required by investor for holding an asset that matures very soon, say next period, and that's only marginally exposed to a shock, right? So when you think about the exposure of this cash flow that matures here to this shock, so the exposure is very low. The compensation required by the investor is actually very high. And the reason why this is the case is that the investor does not only take into account the risk, okay, that this shock causes for consumption tomorrow, but the investor also takes into account the shock, that, the effect that it has on all the future consumption. Right? So the investor is worried about the impact of the shock in the future and reflects this in required compensations for cash flows that actually mature very soon. Now, we can now actually think about putting all this information together. So what do we see? We see that so let's think about the Epstein-Zinn model, the recursive utility model in blue. So we see that these risk compensations required by investors are essentially flat. So if you think about the contribution of the risk compensation part to the term structure of risk premia in this model, okay, it's essentially neutral. Right? Investors do not distinguish by horizon in terms of what compensation they require for holding an extra unit of risk. However, going back now to the exposures to these risks differ by horizon a lot. And in particular, the exposures are small for short horizon and large for long horizons. So when you put together the exposures with the prices required for these exposures, you see that these products will be low for short horizons and will be high for long horizons, meaning that the term structure of risk premia in this model will actually be increasing. Okay? And this is actually a feature of the long run risk model that is known. Okay? and that people thought is contradicted by the evidence until all these papers came that started this controversy about the empirical evidence on the downward sloping term structure of risk premia. Why is this methodology useful? Because it tells us that in this particular model, right, if we want to think about, now imagine that we actually really believe that the term structure of risk premia is downward sloping. So what is the problem with this model? It's not so much in terms of the pricing of risks, which are essentially flat and neutral with respect to the term structure. Okay? The problem is with risk exposures. Risk exposures are very small at short horizons, and therefore the risk premia are very, very low in this model at short horizons. So if anything, we should be looking for cash flow to increase cash flow risk at short horizon in this model. And the problem is not so much in risk compensations. Okay. So there is a long and growing literature now on this term structure of risk premia. I understand that these slides will be posted, so I'll skip it. Yes? So the earlier resolution of uncertainty is a different preference feature. So the calibration, okay, that we prefer for this model, okay, actually implies a very large preference for early resolution. Okay. Intuitively? Well, so this is a different experiment than changing risk exposure. So imagine that I have the stochastic structure of cash flows, and I give the agent the option to actually learn about the realized growth path, or realize about the future realization of consumption, not when the consumption happens, but sooner. I do not allow the investor to change anything. I do not allow the investor to reinvest. I do not allow the investor to change the consumption, to change decisions. Right? I'm only looking at utility consequences of this information. And the preference for early resolution says that the investor would actually like this information and would be willing to pay for this information. The quantitative application in papers by Farish, Strzelecki, and Epstein shows that this willingness to pay for this early information, which is purely a utility concept, does not allow the agent to re-optimize or anything. Okay? This willingness to pay is extremely large. Agents would like to give up massive amounts of consumption just to learn what will happen in the future, even though they have to sit and wait until it happens. No, so that's implications, that's theoretical implications of a model calibration that is calibrated to fit asset prices, right? So some people say that this preference, that this shows that this preference specification is implausible because it implies something about preferences for early resolution of uncertainty that are implausibly large. But of course, now we are talking about experiments that are very different from the experiments that I talked about. Right? Those are just hypothetical experiments that we could think about, but do not apply in this context. Yeah. Okay. So what's the takeaways from that? Okay, it's time to finish. Okay. So I think this literature is a lively field, okay? And there is definitely a lot of scope for early contributions that can become important. And so from the perspective of writing dissertations, this is actually a pretty lively area. Yeah. However, there are things to be worked on. One thing is empirical. So the measurement controversy is there, and we need to take it seriously. Right? The question is how to actually glean from this limited time span of data that you correctly pointed at. Okay? How to glean reliable information. Okay? The second thing is how we actually proceed econometrically formally with this term structure and with this limited information. So Irina Zviadadze, that I already mentioned, has another very nice paper, okay, where she actually does conducts a formal econometric exercise with this term structure. Yeah. And then the next question is, why should we limit ourselves to just dividend strips and look just at stock price dividends? Because we have many different asset classes where we have cash flows with different maturities. Currencies, risky bonds, etc. We can name a few. Okay? So, but ultimately, if we put ourselves into the shoes of an economist rather than like a finance applied guy, okay? Ultimately what we are really interested in is not in correct pricing of these assets, right? But what all this evidence implies for our understanding of the macroeconomy. Right? So then the question is, okay, what a model that is correctly calibrated or to the evidence in the term structure of risk premia, what does it imply for the macroeconomy, say for the labor market? So I have some work in progress on that, or for other components of the macroeconomy. So that's probably the ultimate goal, because it may very well turn out, and that's an open question, that we are trying to fit a moment in asset price data that seems to be salient in asset price data, but it's maybe not so important for macroeconomic dynamics. Right? So that remains an open question. Okay, I'm done. Thank you. Any questions, or like you're the boss? Okay, good.
Yes, it's Sherman degree, which is near the end